Live from New York at the opening bell, this is Business Today, where U.S. stocks have opened lower as fears over a looming government shutdown grow. And the race to secure a last-minute funding deal is back on after the spending bill backed by Donald Trump was heavily defeated. Also on the show, counting the cost of a war economy. Russia keeps its record-high interest rates on hold, defying expectations. And searching for answers, will Google be forced to sell its popular Chrome browser to keep a lid on its search monopoly? Welcome to Business Today, live from New York. I'm Ritika Gupta, and you see U.S. stocks have opened in the red, following on from falls across Asia and Europe. On Friday, investors are grappling with the possibility of a U.S. government shutdown. The losses were somewhat mitigated by that latest Commerce Department inflation report showing the Personal Consumption Expenditure Index, which is the Fed's preferred measure of inflation, rising by 2.4% in November on an annual basis. That's compared with estimates of 2.5%. So that's tempered some investors' concerns about the likelihood of a slower pace of interest rate cuts. So for more on all of this, let's speak to Clayton Trick of Angel Oak Capital Advisors. So welcome. First of all, let's start off with what investors are grappling with this morning, the potential of a government shutdown. They're concerned about those debt issues, as well as still digesting that hawkish cut from the Fed, the anticipation that we may not get as many interest rate cuts next year. So how is all of that feeding into the market action today?
Yeah, good to be with you again. Happy holidays. Yeah, there's definitely a lot going on in the markets right now into this holiday season. The government shutdown is something that we think investors should just look through. I think the probability of something being a longer shutdown is something that investors should look through that risk and think about growth and inflation for next year. This week, to your point, we got the hawkish cut from the FOMC. Today's inflation figure looked really good. It was kind of a return to that longer term trend of inflation coming lower. So I think the bond market is reacting as it should. Interest rates are lower, bond prices are higher. I think that's setting up well going into the last few days of the year.
So Clayton, and we've seen a pullback in stocks, so perhaps we don't get that Santa rally. On the one hand, it could just be some year-end sort of window dressing, taking some profits off the table. Or do you think this could actually be something more than that and perhaps a start of a downturn for stocks?
No, we felt that equity valuations, while on the richer side, and there's a lot of tailwinds to U.S. equity markets going into 2025. We think those tailwinds will still be there. The biggest question, is really how much the FOMC is going to look through some short-term inflation figures, how long they're going to wait for potential clarity on tariff policy. They pointed to 2 cuts for 2025, kind of a pullback of cut expectations. But the main point is that the Fed is still in a cutting bias. They may take a little bit longer to cut rates, but they're there to support markets. That's going to be very good in general for equities in the U.S. That should be very good for bonds and U.S. credit in particular. So while we do see short-term volatility can happen, right? There's a lot of good news that's priced in heading into 2025. But overall, we think the Fed should be supportive. We think inflation in our models should continue to gradually move lower. It just may take a little bit longer for the Fed to cut, but they're in that cutting bias, which is what's been so supportive for equities this year.
All right, well, we'll have to leave it there. Thank you so much to Clayton Trick of Angel Oak Capital Advisors. Happy holidays. Now, that potential U.S. government shutdown is just hours away. That's because a deal on the debt ceiling, which currently stands at just over $31 trillion, needs to be reached before midnight tonight Eastern Time. Otherwise, the U.S. government will default. President-elect Donald Trump has already called for the debt ceiling to be scrapped, but will it cause a major headache before he takes office? We're now joined by Tad DeHaven, who's a policy analyst at the Cato Institute. So welcome. First off, what are the chances or the odds that we do get a government shutdown at midnight tonight? And how did the U.S. get to this point?
So circumstances are changing by the second. And in fact, as I hopped on here, I just read that there's now a third offering coming from the House to avoid a government shutdown. My understanding is the latest version will not eliminate the suspension of the debt ceiling, which President-to-be Trump suddenly called for 2 days ago. So it's curious to see how Trump and by extension Musk will respond on Twitter. But it's quite the fiasco, I have to say.
Yes, quite the fiasco, as you mentioned, Donald Trump inserting himself as well as Elon Musk also being involved in these conversations. Now, you mentioned that incoming Donald Trump now threatening to abolish or calling to abolish the debt ceiling altogether. So why has a debt ceiling become such a controversial issue in the US?
Well, it just popped up in the last 2 days. The debt ceiling suspension was good until March, probably have till June to address it. What happened is Trump wants it done on Biden's watch and has come straight out and said in the last 2 days he wants it pushed past his administration. And what that tells you, for all the discussion about the Musk and Ramaswamy commission to lower debt and campaigning against inflation and stuff and the dangers of debt, is that the incoming president continues, and I say continue because he didn't care in his first administration, clearly doesn't care about deficits and debt and the long-term implications for the economy.
And Tad, separately, Donald Trump has threatened the EU with more tariffs if its members don't buy American oil and gas. How serious is that threat?
Hopefully not serious. The best that can be said is there is a pattern going back to the beginning of his first administration where he issues these one-off tweets and threats and then gets some sort of symbolic agreement from the threatened country or countries. He takes a victory lap and the damage is limited. Although we have seen that he can implement damage and has done so with Europe and as a result done damage to the economic circumstances of this country. So hopefully it's just more bluster. But, you know, at the very least, this creates uncertainty. And what do markets hate? What do businesses hate? They hate uncertainty. And we're getting a real reminder here. Trump hasn't taken office yet, but we're getting a reminder of the uncertainty that can be generated by tweeting at 2 o'clock in the morning about threatening our allies with tariffs.
Thank you so much to Tad DeHaven of the Cato Institute. We'll be keeping you updated with the latest on the US government shutdown. But over to Russia now, where the central bank has made its latest interest rate decision, keeping the cost of borrowing on hold at a record high. The move or lack of a move goes against many analysts' expectations as Russia struggles to tame rising inflation fueled by its war economy and Western sanctions. Let's have a quick look at those numbers. The main interest rate has been held at 21%. That is the highest on record, which the central bank put in place in October in an effort to tame persistently high inflation, which rose again last month, coming in at just under 9% in the year to November, and all of which is putting huge pressure on the economy as prices hit consumers and high interest rates strangle growth. During President Putin's end-of-year press conference on Thursday, he described the growth in prices as an unpleasant and bad thing, but that the economy will cope. Chris Weaver is the CEO of Macro Advisory Limited in Moscow. He gave us his reaction to the decision to hold the interest rate.
It's excessively high, even relative to the inflation rate. What the central bank had said when they raised their rate, the justification is they are fearful that inflation could spike a lot higher coming in next year because of what they called an overheated consumer economy. We have seen, a rapid increase in consumer spending this year, fueled by rising wages, some of which, of course, is caused by the high costs or the high wages being paid in the military industrial sector. A lot of it is because of declining workforce. Unemployment is down to about 2.3%. So wages have been rising at about 20% this year, over 10% in real terms. And we've seen a rapid increase in, for example, in the purchase of cars or expensive durable goods. Car sales are up over 100% this year. So the central banks say that they've been worried that this could lead to much higher inflation next year. And they say that the reason for the high rate is to cool that. Now, the evidence is that in November, that's starting to work. Car sales were down from 180,000 units in October to 130,000 units in November. So basically they say that their strategy is now working and therefore they don't need to raise rates further. But of course, they'll keep the option open.
The Tech giant Google is today expected to counter demands by the US Department of Justice that it sells Chrome, the world's most popular web browser. That demand is one of a series of remedies aimed at stopping the tech giant from maintaining its monopoly in online search. Adam Epstein is the co-CEO of Ad Marketplace and an advisor to the US Department of Justice antitrust team.
Today we'll see what Google finally has a chance to speak after losing the 286-page liability decision in the last summer. So it will be anything from a choice screen option, which is unlikely to be effective or compelling to the judge, all the way to offering to spin Chrome out into its subsidiary in Alphabet, which again, is sort of just changing the labels, but not really the structure of how things would operate. It will be interesting to see if Google takes this opportunity to do something that would actually be meaningful and create competition and transparency and innovation in search. And that would be something along the lines of saying, hey, we're going to go ahead and change how we license our licensing agreements work with our search ads, our search results, and allow these browsers and phones to really customize and curate their own search experiences on their own devices, on their own pages, and create really differentiated and unique search experiences. That would be a really step in the right direction. I think something that the courts would find compelling, and that would really serve users in the entire industry. So there's a bunch of options they have, and this will be their first chance to really speak about how they're looking to approach their future in search.
And in other news, a formal inquiry into the fall of the bank Credit Suisse last year has blamed complacency and greed by its managers. The parliamentary report said Credit Suisse lost $37 billion in the years ahead of the collapse, while top managers were paid performance bonuses of over $44 billion. The workers' union, representing more than 10,000 Starbucks baristas, said its members will strike today in Los Angeles, Chicago, and Seattle. Workers United represents employees at 525 Starbucks cafes across the U.S. The union said strikes may escalate in the run-up to Christmas unless a collective bargaining agreement can be reached with the Starbucks HQ. And U.S. egg prices have hit an all-time high after millions of hens were impacted by an accelerating outbreak of bird flu. Prices for a pack of 12 eggs now average around $5.50, which is 150% higher than a year ago. Prices are even harder to stomach in California, where the average price for a dozen eggs is over $8. And that is it for Business Today. We'll be back in the new year. Thank you so much for watching, and we look forward to seeing you in 2025. Goodbye.